Are you looking for the best way to pick the perfect dividend stock? Since the average investor doesn't have Warren Buffett to show them how to do it, we've laid out our top 5 ways that any investor can pick a winning dividend stock that gets safe, stable, and growing passive income. The first factor we look at is the track record of dividend growth year in and year out. 5 years of dividend growth is the absolute minimum. We typically like to see at least a 10-year track record of increasing dividends, if not 20 years. The next number you want to look for is the payout ratio, or the dividend coverage. This ratio explains how much of the company's profits are used to pay the dividend. The higher this ratio, the riskier it is. You want to buy a company that only pays out a small percentage of profits as dividends. Or in other words, you want to have a dividend that's safe and has room to grow, and will be reliable even in the bad times. We like to look for between 30 and 50%. The third metric you want to look for is debt. The more debt a company has, the riskier it is to own. We look at the debt to equity ratio to assess the margin of safety for a company. A debt to equity ratio of less than 50% is reasonable, meaning there will be some equity left over for the shareholders in the event of a bankruptcy. Rounding out our list is the fourth important factor, and that is the dividend yield itself. You don't simply select the highest yielders and call it a day, but you also want a yield that is generally attractive and competitive with fixed income investments like T-bonds and treasury bills. This allows you to capture a lot of return through your dividend reinvestments, and dividend yields tend to move with interest rates. And finally, the most important factor in any investment decision is of course the price. As Warren Buffett says, even the greatest companies in the world can be a terrible investment if you pay too much for them. A general rule of thumb for beginners is look for a price to earnings ratio of close to 17 and a price to book ratio of less than 4, and of course that it passed the first 4 rules. If you follow these simple tips, you can rest easy knowing you own great companies with fantastic track records of paying dividends, and you paid a fair or even bargain price. If you want to learn more about dividend investing, be sure to visit dividendalpha.com and subscribe to our perfect dividend portfolio to automate your passive income.